Hello and welcome to Weekend Investing Daily Bytes. We're shooting episode 249. And what a gory date was 20th of June 2022. Small caps and mid caps were demolished like never before in the recent past. The Nifty remained in the green, almost camouflaging the brutal bloodletting that happened in the breadth of the market, and a lot of people calling end of small caps or end of the markets and so on and so forth. We'll discuss about what small caps have done in the last decade and a half and how the journey has been, what have been the falls earlier, how have the recoveries happened, whether they recover or not, and how quickly they recover from that. But first, a look at the bloodletting in the market. Metals down 4%. They were down almost 5.5% at one point. Public sector enterprises, stocks like BEL, HAL, which were very, very strong so far, got hammered today. PSU banks, several of them were brutally kicked down. Private banking, several names have been very weak. IndusInd Bank, RBL Bank, Bandhan Bank. But yes, of course, the market leaders, HDFC Bank, etc., were in the green. Commodity stocks badly damaged after Vedanta offered to Vedanta copper plants have been put on sale. Uh, Down 15%. Hindalco also down. Several other commodity stocks, Hindustan Zinc, in copper, all of them down. Energy stocks brutally beaten. JSW Energy, Tata Power, real estate stocks, infra stocks. So across the board, minus FMCG, some consumption stocks and some IT stocks, and one or two pharma stocks. I think most of the sectors were badly beaten. Bank Nifty overall was flat, but there was a huge divergence within the Bank Nifty with many public sector banks diving down. Nifty overall closed 0.37% up, but as I said, it camouflaged a lot of damage that has happened uh, inside. You can see that some of the sectors have reached a minus 29% for this current financial year. So, metals and IT are the two leading sectors which have dropped the most, with real estate and commodities following on the financial year basis. So, as I said, broader market extremely divergent from the large caps. Nifty Next 50 down 0.75%, mid and small cap down 2.5%, and small caps down 3%. Uh, Within this, also, I mean, the number of stocks that hit more than 5%, the list is very, very long today, and several of them going even below 10%, more than 10% fall within the mid cap and small cap names. Some large names also falling very dramatically today. Within the weekend investing small cases, everything got demolished. Just look at the damage. MI20, MI35 dropping 6%, MI80H dropped 3.7%, Evergreen dropped 2.5%, MI25 dropped 2.38%. And several of these drops, while they were in 1 to 2% range, these are coming on the back of still sitting on large cash. So the brutal murdering of whatever stocks were there in these portfolios also is very, very damaging. No place to hide here. NNF10 down 1.19%, LTCNX 200 minus 0.9%, and NG5050 minus 0.17%. So really one of the worst days, I think, definitely of 2022 and of the recent falls as well. Heat map for the day: Reliance, ONGC, Coal India, Tata Steel, all were down dramatically. Asian Paints, Lever, Infosys, HDFC Twins, Wipro, they were up along with Ultra Semco and Grasim. And some of these consumption names were kind of flat or slightly positive. So you can see here that it was a kind of a mixed bag on the large caps. So maybe there is some sense of some large cap buying that is emerging at this place, and the recovery, whenever it comes, will be led by large caps, I feel. But right now, on the small and mid cap front, it is a bloodbath like no other day in this year. In terms of top gainers in CNX 500 universe, ITI up 12%, Pidilite up 5%, Godrej Consumer up 4%, Tube Investment and HUL also up 4%. In the following stocks, MRPL down 19%. I mean, the stock was so strong just last week, and just a small blip in oil has caused a dramatic fall here. For fertilizer and chemical, down 14%. Vedanta, as I said, down almost 13%. Bandhan Bank down 12%, and Bharat Dynamics down 11%. All some of these very strong counters that have been holding up have suddenly and dramatically collapsed here. So a lot of call of end of small caps, and small caps will never recover, and so on and so forth. So we wanted to go back and see what happened in the small cap history so far since the last 20 odd years. So what we can see here is that the small cap, and this is the small cap 100 index, the small cap 250 does not have that kind of history, but small cap 100 index has had 4 major falls in the last 18 odd years of data. So this first rally was, small caps went up 6x and then dropped 77%. And then it went up almost, I think, 3x and then dropped 46%. And here again, it went up about 4x, dropped 66%. And currently it had gone up about 4x again, and so far dropped about 35%. So compared to the past 3 falls, 35% is still not the average of the last many falls, but it is anybody's guess where this will stop. It may stop here and we start going up from tomorrow, or it may come down to 6,000 and then go up. Nobody can really say. It all depends upon what kind of flows that will keep coming as selling outcome in the market, and what is the sort of confidence level in the market. The situation on the FII front on the large caps has not improved. FIIs are still selling. Today's data is important. I think there may be some change there. Domestic funds are still buying, but if domestic funds dry up, then of course we have a problem. Those who follow fundamental investing, and I don't, are saying so that the valuations have become reasonable. So we are definitely not in froth territory anymore, and we are more near fair pricing than froth, but it could get much cheaper as well. So my sense is that we may be at that stage in the market where if you are investing, in a couple of years you should be in great profit. I mean, that's my guess. I mean, if you were sort of investing starting here, yes, you would have got hit, but in a couple of years you would have made up. If you entered here somewhere in the middle, yes, you would have taken time but gone up. If you would have entered somewhere here, yes, drop would have been there, but you would have made up. So if you are gradually bringing in your capital, it's a good time to bring in more capital or to start investing at least. So from that perspective, I'm not thinking that this is not coming back. But if there is a global recession of 1929 kind, then yes, we will come back to maybe 3,000. That possibility always remains. So no quick fixes or any Goldilocks fairy tale to tell here. I mean, it is extremely damaging. Many of our strategies have gotten beaten blue and black, no doubt about it. The fact is also that several of these strategies have seen much deeper falls in the past and have recovered. So that gives us confidence that this is not anything very unique that is happening for the first time. But yes, I mean, from a perspective of nobody likes a fall. I mean, I don't like to lose money. I don't like the portfolios going down. But that's how the market is built. So we will have to sustain these falls with some confidence that tomorrow will be better. By tomorrow, I'm saying the coming months and years. Now, 2 insights here, just thoughts. that if you exit a stock and that goes up later. So in momentum investing especially, there will be times where we will exit some stocks. That exit may already have come after we've lost some or all of the profits on it, and it may feel weird. It may also exit at a bottom, and the stock may go up from there, and we may pick it up again maybe later. That may also seem very weird. So a lot of weird things will happen when you follow a system and you don't put any discretion to it. So the idea is to follow strategy with discipline and keep the discretion out, and hopefully that will ride you out of all the down trends that we get to see. The other is, of course, how you have built up your entire allocation. So while I know most of you are very young and most of you would like to keep most of your money in equity, as you grow older or you mature more, you would want to diversify your asset allocation from equities into other asset classes, real estate, gold, debt, crypto, whatever you like, and sort of not just rely on equity for your growth. So while equity remains the best asset class for returns, it also gives you the best volatility, and that creates uncomfortable situations for some folks. Many folks are very risk taking in nature, and they understand that their portfolio could go down 50-70% and they're fine with that. Several of other people are not fine with that kind of ups and downs in their overall net worth, and they would want to have more of asset allocation towards lesser volatile asset classes. So just as an example, if Mr. A was sitting with a diversified asset portfolio, let's say 20-25% into equity, 20-25% into real estate, 20-25% into gold, and 25% into debt, he may be down 5-7% right now from the top, and that may be more comfortable for few people versus having double the size of portfolio but being down 30%. So it all depends upon how you are training your mind to deal with the vehicles or the asset allocation that you've done. If you are more risk averse type of person, then obviously you would want less exposure to equity. If you are a sort of more daredevil type of person, you are happy to take higher risks in life, and maybe it is in your stage of life that you can take higher risks, and your financial advisor has advised you to take more exposure to equity. That is fine. I mean, equity will reward you handsomely. But having taken those decisions that I want to put 90% into equity, then a 20-30-40% fall should not bother you as much, because you've consciously taken that decision that I am willing to bear that volatility. So if you want to be in equity, be comfortable with volatility. If you are not comfortable with volatility, don't be fully in equity. That's what I'm saying. So you can't come into equity and expect that there will be no volatility. That is a expectation that is wrongly built into you by whoever is advising you. So have the right expectation of the vehicle that you are traveling in, and that will make you enjoy the journey more. And even if not enjoy, at least you will not panic. If you know in the back of your mind that yes, so much of my capital is allocated to equity and this can give me this volatility. So having that presence of mind, having that acceptance of that instrument or asset class is very, very important. So there's no right or wrong answer here. I'm not trying to judge anybody. I'm not saying you should be Mr. A or Mr. B. As per each person's personality and behavioral traits, as per your endurance of risk, you have to fit yourself somewhere in this range where of no risk to max risk, somewhere like that. So that will help you in getting to a allocation where you will feel comfortable and you will accept that yes, I've gone 100% up in 2 years, now I'm getting 30% down, so that's fine. So that kind of a gradual maturing of your idea towards equity has to happen. And once 2, 3, 4, 5 years have passed by, you will obviously on your own, appreciate that how I've allocated to equity. Should I increase it or should I decrease it based on your understanding of it? So this is all I had for today's Weekend Investing Daily Bite. Thank you so much for watching. Please do like and subscribe to this channel. Please do also share it with your friends and family. A lot of people are investing blindly and getting stuck with tips and all kinds of hearsay. Please do share with them that there can be ways of having a more disciplined approach. Yes, profit and losses will happen in this also, but hopefully over a period of time we will sail out with flying colors. Thank you so much. Bye.